Hello, my name is Keith Schrader. I'm the author of the Wealthy Accountant blog. Today we're going to be discussing cost segregation studies and how to apply them on a tax return. So, a cost segregation study is a way of taking a piece of real estate and accelerating some of that depreciation that normally would be depreciated over 27 and a half years for a residential property or 39 years for a commercial property. This is a cost segregation study which can actually get quite lengthy. Sometimes they can be 30, 40, 50 pages long. What you really need for your records is you need the cost detail and the cost summary. And if you need to file Form 3115, in other words, if you've been depreciating the property prior to a cost segregation, you will need to file Form 3115 for a change of accounting method. You'll need to scan and attach these pages to the return. The cover letter, which is going to come from the cost segregation company, and the cost detail that is going to be included. If you have a property that has multiple sections, for example, maybe you have a detached garage that is used for something different, maybe you have some commercial versus residential in the property, then the cost segregation study can get long, but you just have to go through this whole process that we're going to talk about in this video for each one of those sections, and that will bring everything into reconciliation on that too. If you've been depreciating for a number of years and now you have a cost segregation study, you're going to have some adjustments made, which means you're going to need Form 3115, which is the application for change in accounting method. The form is pretty straightforward. Pages 1, 2, 3, and 8 are the pages that are going to have entries. The rest of the form will actually have no entries because they don't apply. So on page 1, you're going to enter your general information on the top. The one thing I will note that on the right-hand side, it's going to say the year, the tax year, the change begins. And that's going to be the year that you're going to be applying this cost segregation study. The year that the change ends is going to be the actual end of the class life of the property. Then you're going to check on the right-hand side in the middle if it's an individual corporation, partnership, S corporation, or any of the other entities there. You're going to check the box on the right side for depreciation. The biggest thing that's going to give you some issues is going to be the DCN, that designated automatic accounting method change number. For a cost segregation study, the code is 8, and that's because we're going from a permissible form of depreciation to another permissible form of depreciation. The rest of the page is going to be some questions. Page 2 is going to have some questions. Page 3 is going to have some questions on the top third or 2/3 of the page. The bottom third is going to be the beginning of the part that doesn't apply to what we are going to be doing that involves a cost segregation study. Now you can answer the questions and copy what I'm doing here and cheat a little bit if you want and just copy what I'm doing. The problem is that you do need to answer the questions correctly though. So in some cases you're going to have a question, for example, on page 8, which is going to ask, have you ever lived in the property before? And if the answer is yes, you need to, of course, answer that yes and make any adjustments that are necessary. On page 8, of course, you're going to just fill out that bottom 2/3, that's Schedule E of Form 3115. There's going to be 5 questions that need to be answered. I have a statement actually attached to this, and this is my software. It just kind of pushes things out. I put the information in. I think if you provide the cost segregation study as an attachment, that may not be needed, but I generally enter the information anyway. The attached schedule, that supporting document, really just lists that it's a duplex in this case. In our example, we're going to be using a property that started in 2014, and that it's residential real estate. So the next thing we're going to go to now is talking about the math, and this is the part that can get a little bit interesting. What we're going to do, and I'm going to have some sheets up on the screen here. These are really kind of nice to go to the blog post, and if you click on the blog post on each one of these, they're going to pop up on a separate screen, or pop up so that you can actually copy them and print them. It's actually kind of nice to do that as you go forward, because otherwise it gets a little more difficult to apply in your own personal situation. So we're going to start out with some basic facts. We're going to have a tax return that has a duplex that was purchased on January 1st of 2014. I'm doing this to make it easier so we can use calendar years. Keep in mind that depreciation for straight line is actually by the month, so you will actually have to make an adjustment by the month versus the year, and that will be applicable to whatever your situation might be. In our case, we're using a fairly low value property here. Again, keeping numbers pretty simple. A $400,000 purchase price. The depreciable portion of the property, the building itself, is $355,309. The land, which is never depreciable, so we're going to disregard that afterwards, is the remaining amount. Now the tax return is going to have some changes on it, so we're going to take a before and after look at the tax return. Schedule E, again, I'm going to use some fairly out of tune numbers, but I'm using them just so it shows clearly what is going to work, and I don't want to bring in things like passive activity rules or things like that, because then we're going to be going off in tangents we don't want to. So we're going to have this property here, the Schedule E, without the cost segregation study. It's going to be a continuation of what you've done, and we're assuming, again, we started in 2014. We're going to assume that we've been depreciating this as we were supposed to at 27.5 years since 2014, so for 6 years. You can see the Schedule E, and then you can actually see the depreciation schedule, which actually shows the depreciation that has been taken up into 2020 and including 2020. Now, also, just as a note, I am doing this with the 2020 tax return. That does not mean that this will not work in other years. It's going to work this way consistently across all tax years unless they change the rules, and then I will come back and actually change the video as well as the blog post. And the reason for that, the 2020 tax return is just the most current tax software that I have, and it shows very nicely what we're trying to accomplish. So you have the depreciation schedule showing the land and the actual duplex, the building itself. You're actually then going to see the amount of depreciation that was prior, the $77,522. You need to have that in our calculations as we take and adjust for the cost segregation study. And then we're going to have the current depreciation if we had done nothing. And that's just to show us as a starting point. So if you're doing the tax return, if you're a tax professional, or if you are doing your own tax return, this is what your computer is probably, what the software is going to populate automatically for you unless you make some adjustments now. So the next page we're going to look at now is catching up that depreciation. So we got to do the calculation. So before we start the whole thing, we have $355,309 of 27.5 year depreciation. This is always going to be done at straight line. After the cost segregation is done, we get a couple of different numbers. Some of the $355,309 is now going to be allocated to 5-year class life and to the 15-year class life. The double declining balance, that 200% declining balance, and the 150% declining balance are what is called makers. So a tax professional will understand this. Your software is going to do it automatically because this is the most common type of depreciation, and that will be the depreciation that will be used as we make these adjustments. Moving on to the third page, we have to do a little bit of math. So what we have is remember that first page that we used, that depreciation schedule showing $77,522 of depreciation? Well, we have to do something with that because some of that should have been applied to the other portions, if you will. So you had actually $355,309 being depreciated, but in reality, we should have only had a little bit less than that. We should have had $262,816 being depreciated at 27.5 years, because $85,600 was actually 5-year class life, and $6,893 was from the 15-year class life. So what we need to do is we need to adjust out some of that. So we need to know how much depreciation would have taken place had we done the cost segregation from day one. So that $262,000, which we get from the cost segregation's summary detail, That 262,816, we're going to divide that by 27 and a half years, the depreciation class life or straight line, and then we're going to come up with $9,557. And since we've been depreciating it for 6 years exactly, again, it's easy figuring here, we come up with $57,342. Now this is different than the original depreciation we had, which was our original depreciation, which was actually $77,522. We have to break that down. So we know that the $57,342 is the portion that's going to stay with the 27 and a half year class life of the depreciable property. You'll have to make an adjustment in your tax software for this depreciation schedule, and then the remainder, the difference, is going to end up being allocated to the other classes. So the next part of the placard is going to show us the math. For the 15-year class life, there's $6,893. We're going to divide that also again by 27 and a half years. That comes to just over $250 multiplied by 6. We come to $2,502, and if you notice, this math doesn't work out exactly because when we're going from the original depreciation, we're going to be rounding things all the time in our examples, which you can do in your tax return as well. And as we're rounding, there's going to be some rounding errors. This is where I caught up and reconciled that rounding error. It's $2 off, so instead of being $2,504 and change, it's going to be $2,502. That will actually reconcile everything out. And then for the 5-year depreciation, you take the $85,600, divide that by the 27 and a half years of the class life, and that comes up with $3,113, but times 6 years, $18,678. What you need to do is you need to add this on your tax return in 2 new lines. So for the 15-year property, you're now going to have a starting basis or a starting date of 1/1 of 2014. That's the original date the property was purchased. You're going to put down that $6,893 is the basis that needs to be depreciated, and that the prior depreciation already claimed was $2,502. And remember, going up to that one step above the 27 and a half year, remember your software is going to say $77,522. You need to change that to $57,342. And then the depreciation basis, of course, is brought down to $262,816 in the 27-year class life, so that it all reconciles out. The 5-year class life is going to be the same thing. You take the math, you have $85,600, which is going to be allocated to 5-year. The depreciation that was taken at 27 and a half years came up to the $18,678. That needs to be put in as prior depreciation. The last step is calculating the additional depreciation to catch up with the cost segregation. Since the 5-year class life has already been completely used up, that means that any remaining basis in the 5-year class life property is now going to be deducted in full because you filed the 3115 on the current tax return. So the $85,600, we had to make that adjustment, and we came up with $18,678 of allocated prior depreciation. We subtract that, there's another $66,922. You need to override what your computer is going to automatically want to do, and you're going to put in the $66,922 as the current depreciation, because that is what your deduction for that depreciation for that class life is going to be. For the 27 and a half year, we're going to jump to the bottom of the page. The computer's going to take the $262,816, and it's going to go ahead and calculate the correct amount for the current year and then going forward. It's going to add those together on the tax return, which we'll show last. The 15-year class life is going to take a little bit of additional work. For example, you can't just do what we did with the 5-year and just write all the remaining off. What's going to happen is you're going to be partially through the depreciation schedule of 15 years, but not all the way through. Now, when you look at the card that I'm showing you, you're actually getting, I'm circling or squaring out, highlighting 7 years of depreciation on the 15-year property. The reason why that column is showing 7 years being encircled is because we're doing 6 years previous and we're doing the current year. What we want to know is what the current year deduction is going to be, including previous years. So we have to take the 7th year because we're including the current year. So we want to make sure we understand that. If you're doing this with multiple properties, or if there's class lives where things are all going to be in this chart, you have to make sure that you make these adjustments accordingly. The reason why is you're going to feed into the computer the actual depreciation, because the software is not going to be able to calculate it correctly. You're going to do this by hand, and you're then going to manually enter this in and override what the computer normally, what the software would normally want to put in. You take the $6,893 and you multiply it by 48.81% in this case, because if you add up 7 years of depreciation on a 15-year schedule, you come up with 48.81, and that's the percentage that has been used to date. If you calculate that out, that's $3,433. That is the amount of depreciation you would have gotten had you been depreciating with a cost segregation all the while. But what happens, though, is you only took $1,502, remember our allocation from that original 27.5-year property. That $1,502 gets subtracted from the $3,433, and that gives us another $1,931. That is actually going to be your current depreciation. When you add these into your software, what's going to happen is you're going to have, the software is going to actually add the numbers to each class life all together and put it on that one rental property. So on Schedule E, you're going to see here that, so there's quite a big difference on the Schedule E from the first one, because we're going to go from a lower 5-digit number for depreciation all the way up to $78,000. A nice way to look at this, I'm including here as well, is the depreciation detail. And the nice thing about this, it's going to show you each one of those items clarified. You're going to see the prior depreciation that we had talked about with our calculations. You can manually put these into the software. You're then going to see the current depreciation. The 5-year and the 15-year is actually an override that you put in. That's our calculation that we did. And the duplex for the main property, the 27.5, we made an adjustment to the depreciable basis, and then the computer did the rest of the math for you automatically. So that's what it is in a nutshell, to do a cost segregation study and apply it to a tax return. It's not so much that it's hard, it's that you have to actually think the whole process through. I think the blog post is a great place to go. You can start with the video as well if you're more of a visual person. But it certainly is kind of nice to have some of these printouts that I've made, and you can literally highlight them, print them out. I would recommend bookmarking the blog post, because whenever one of these come into your tax office, or if you're doing this, if you're watching this video, it's almost certain that you're dealing with the issue or considering it. So you want to bookmark it, because I'll periodically make some updates with it. If there's any questions, you can leave them in the comments. If there's something you'd like me to address a little bit differently, let me know. I can certainly make some adjustments, especially on the blog. I would be making changes if there's something that's not as clear to someone, and going forward, that would be a continually enhanced and growing resource for you. Thank you, and I appreciate you taking your time to be with me today.